From an investor's chair, the first rule is simple. Never ignore a deal this big when the president walks onto the stage and says, "I'll be involved in that decision." Netflix has agreed to a roughly $72.83 billion acquisition of Warner Bros. Discovery's core assets, the Hollywood studio, HBO Max, and major streaming rights, in a move that would merge the world's largest streamer with one of its biggest content libraries. On its own, that's already an antitrust headache. Netflix plus Warner would likely control well over 30% of the U.S. streaming market, the rough threshold regulators used to start worrying a merger might crush competition. But then Trump stepped in. On the Kennedy Center red carpet, he told reporters Netflix has a very big market share, warned that adding Warner could be a problem, and said flatly, "I'll be involved in that decision too." That single sentence changed the risk profile of the deal. In a normal system, the Justice Department and the Federal Trade Commission conduct the review, semi-insulated from day-to-day politics. In 2025, everyone knows the reality is different. Trump has already made clear he doesn't see much distance between what he wants and what his regulators do. His own aides have signaled significant skepticism inside the administration, calling Netflix's growing power a legitimate concern. Progressive senators like Elizabeth Warren have slammed the merger as an anti-monopoly nightmare that would hurt consumers and creators. And rival studio groups, especially Paramount Skydance, are telling Warner's board that Netflix's bid may never close because of regulators in Washington and Europe. Put all that together, and you don't just have a big media deal. You have a three-way fight between Netflix's vision, Hollywood's rival bidders, and a president who sees leverage. Start with what Netflix is trying to buy. Warner Bros. Discovery brings an Oscar-winning film studio, deep franchises, and HBO's prestige television library. Combining that with Netflix's global distribution and recommendation algorithms would create a content machine capable of shaping culture at scale. Antitrust experts point out that the merged company's market share would cross key thresholds in the new DOJ guidelines and would likely trigger a formal presumption of harm. Regulators worry about higher prices for subscribers, fewer competing shows, and weaker bargaining power for writers, actors, and smaller producers. Hollywood unions have already warned that the deal could mean fewer greenlit projects, less diversity of buyers, and more pressure on wages behind the camera. In plain language, one massive buyer controlling the pipeline makes it harder for everyone else to negotiate. Netflix, of course, tells a very different story. In its messaging to investors and press, the company argues that the deal would generate economies of scale, let it spread production costs over a larger base, and ultimately give subscribers more choice at better value. It points to existing competition from Disney, Amazon Prime Video, Apple Television plus YouTube, and regional platforms to argue that even a larger Netflix Warner would still face intense pressure. And it insists that integrating Warner's brands would create creative synergies, not a monopoly. Analysts are split. Some believe the combined entity could drive strong earnings and stock performance. Others warn that the antitrust risk is so high that the market should discount any promises until regulators actually sign off. Then there's Paramount Skydance, lurking in the wings with its own bid. Paramount has sent letters to Warner's lawyers arguing that its alternative offer, though slightly lower on headline price, is more realistic because it would face far fewer regulatory challenges. It has even floated the idea of a hostile approach to Warner shareholders if the board keeps betting on a Netflix deal that may never close. That's not just posturing. It's a reminder that boards have fiduciary duties. Turning down a deal that's more likely to get approved in favor of one that may be blocked can become a legal liability. Paramount also has another advantage. Analysts note that it has historic ties to Trump-aligned figures, which some see as giving it a slightly friendlier political profile compared to Netflix, whose leadership and brand are often seen as culturally liberal. This is where Trump's own relationships matter. He has praised Netflix CEO Ted Sarandos as a great person who has done one of the greatest jobs in the history of movies, according to one account of their Oval Office meeting. At the same time, he has a long memory of media coverage, Hollywood attitudes, and perceived bias. By positioning himself as the referee, he keeps maximum flexibility. If he blesses the deal, he can claim credit for enabling a world-beating American champion. If he blocks it, he can say he stood up for competition, lower prices, and maybe even for a rival studio that played ball. Either way, his message is the same. In this town, even the biggest companies need the president's approval. From a system perspective, that should make you pause. Antitrust law is supposed to be about market structure, not presidential moods, Modern guidelines talk about concentration ratios, barriers to entry, and the risk of coordinated behavior. They don't talk about whether the CEO visited the Oval Office last week or which studio executives donated to which party. Yet news coverage openly notes that Trump has dispensed with the notion of distance between his personal preferences and what regulators do. When a $72 billion deal is understood by markets as partly a bet on one man's instincts, you've drifted from rule-based capitalism into personality-driven capitalism. For short-term traders, that's just another volatility source. For long-term capital, it's a warning about regime risk. The stakes go far beyond whether Netflix gets a new library. If the deal is approved, it accelerates a pattern where entertainment, data, and distribution concentrate into a few mega platforms. A Netflix Warner giant would control huge amounts of content, viewing data, and bargaining power with internet providers, device makers, and advertisers. That could enable aggressive price hikes once competitors weaken, subtle forms of content bias, and outsized influence over what gets greenlit or canceled. For creators, it means fewer doors to knock on. For viewers, it may mean higher subscription bundles and less true choice, even if the content library looks bigger on the surface. For democracy, it raises familiar questions. How comfortable are you when the shows people binge, the news documentaries they see? And the comedy specials that shape political jokes are filtered through a handful of corporate dashboards overseen by regulators who answer to one man. If the deal is blocked, there is pain too. Warner Bros. Discovery is heavily indebted and under pressure to find a strategic solution. A failed Netflix bid could trigger breakup fees reportedly in the billions, further weakening Warner's position. It could also embolden private equity buyers or foreign players to step in with offers that face different regulatory questions. For Netflix, a rejection would be expensive. Deals of this size often come with large reverse breakup fees and sunk advisory costs. The company would need to explain to shareholders why it swung for the fences, reignited antitrust scrutiny of its size, and came up short. Rival streamers would cheer, arguing that regulators finally put a limit on how big any one player can get. But the underlying pressures, rising content costs, subscription fatigue, and the shift of ad dollars would still be there. The consolidation wave would slow, not stop. So what would a cautious billionaire do watching this drama? First, refuse to build a thesis on any single regulatory outcome. Analysts already say the deal could face years of review, with high odds of court challenges even after an initial decision. That means you treat Netflix and Warner as volatility trades around headlines, not as pure long-term compounders based solely on this merger. Second, focus on the underlying trend. Whether or not this particular deal closes, the streaming market is maturing, subscriber growth is slowing, pricing power is contested. Content spending is under pressure. That favors platforms with multiple revenue streams, advertising tiers, gaming, licensing, live events, over those dependent on endless subscriber additions. Third, pay attention to what this episode reveals about the U.S. regulatory climate. If Trump leans into a tough stance here, it signals that even a business-friendly White House is willing to flex on tech and media consolidation when it suits its narrative. That has implications for other big tech deals, data-driven acquisitions, and cross-sector mergers. If he ultimately waves the deal through after some tough talk, it signals that enough lobbying and political alignment can still get almost anything approved. Neither is a rule of fi deal. But as an investor, you care less about ideals and more about patterns, who gets told no, who gets told yes, and what that says about which business models political power is comfortable with. At the end of the day, the title question is simple. Who really controls what you watch? Is it the market where the best ideas win? Is it a handful of boardrooms in Los Gatos and Burbank? Or is it increasingly a mix of boardrooms in one office in Washington where a president can raise an eyebrow and add years of delay to a $72 billion transaction? For now, all three forces are pulling at the same screen. The more concentrated the industry becomes and the more personalized regulation becomes, the less your remote is steering anything.